the Business Finance Podcast, brought to you by the Best Finance Group. New episodes every Friday. Hello and welcome to the Business Finance Podcast. I'm delighted to be joined today by Ian Keevil-Smith from Skipton Business Finance. Ian, thanks for coming.
Thanks for having me.
Nice to see you. How are you doing?
Yes, very good, thanks. All good, yeah.
Ah, brilliant. Well, thanks for coming down to see us. You're our first external guest on the podcast, so no pressure.
Indeed.
No, you're going to be brilliant. So really glad you came down. So we're going to just touch on a few things that obviously a lot of our audience are either business owners or accountants, business consultants. So we thought it'd be great to look at the various types of invoice finance from a lender's point of view.
Yep.
So we're going to run through a bit about the Skipton and the Skipton Group, and then just some of the different products and just some general advice for people that are looking for invoice finance.
Yep.
So if that's all right with you, we'll get cracking. So perhaps you could tell us, you've been in the industry a long time, perhaps you just give us just a quick overview of your background in this industry.
Yes, so obviously I've been in the industry about 15 years now, across 2 lenders. Been at Skipton just over 8 years. I actually started on a graduate scheme in the start of my career, so I'm pretty passionate about bringing the next generation of talent through our industry as well, which I think probably needs to be, because it's lacking our industry at the moment.
Brilliant. And tell us a little bit about Skipton Business Finance and the Skipton Group, and specifically what makes, you're a very well respected lender. We use you a lot for our clients. If you just tell us a little bit about Skipton and what makes you different, I think that'd be interesting for the viewers as well.
Okay. So obviously Skipton the business finance arm's been going about 25 years now. So obviously based in North Yorkshire, slowly grew, and opened offices as we came down the country. I obviously head up the southern region of new business, and we've grown massively down here, but based on our brand more than anything. So as you mentioned, we are a mutual, so it's quite unique in our industry that our group company is owned by its members, so we don't have any big dividends to pay shareholders. It's all reinvested back into the business. So I think for us that is probably our one of our key sell points, because it allows us focus on long-term value. So we're really big into sustainability. So one of our big things at the moment is we've launched a thing called Kogo, which we're going to give all of our new clients, which effectively is is like a tool which plugs into your account software, which tells you your carbon footprint and ways to improve. So that's the way we just want to add value to some of our clients as well. I suppose we reinvest all of our profits back into the business, so that gives us more cost-effective solutions, and I suppose better levels of customer service. And I suppose the last thing that the mutual aspect brings to us is probably it allows us to prioritise our customer support, so we can offer like very tailored and flexible funding solutions, which I think really shows through. We've got about a 98% client satisfaction rate across the business. In the south last year, talk about our growth, we actually funded new client turnover of 390 million just in our business sector. Yeah,
and you've got very good relationship managers. Our clients always speak very highly of the relationship managers. They can pick up the phone and they have mobiles and they can actually get through and speak, and they get to know the clients really well.
Yeah, it's great. They're all managed locally. Relationship management staff are great. They've pretty much all been with us for a number of years. I think anyone's really moved on, and it's having that personal relationship locally with the customers, which I think really puts us stands the streets ahead of the rest of the competition.
Yeah, no, that's fantastic. Yeah, very good. That's brilliant. Thank you very much for that. So we're just going to run through. We've got split the products into 2. So we're going to talk about the invoice factoring and discounting just very briefly. And we're going to talk about the interest-only product, which is quite unique in the industry as well. And so I'd like to know, from your point of view, when you tend to recommend the interest-only product. If you could just tell us just a very quick overview about the factoring, discounting and the the interest-only product.
Well, I think it's very important for a lender to have a wide range of product set, because when you look at a business, it goes through the business cycle. So from startup, high growth, some distress, turnaround, and then potential exit. But you tend to find a business will go along that curve up and down. So from a funder's point of view, you want to be able to support all elements of that curve. So if you split them into 2 products or 2 product sets that we have, you have your invoice factoring, which is for more new start companies, or potentially where a company's in distress or turnaround. And from a lender's point of view, you want to have a better viewpoint on your debt and the collectability of that. And that then builds into the Select product. So the Select is what we call our interest-free offering, but it's basically a fixed fee against the invoice value. So from a business owner's point of view, sometimes in our industry and mortgages and any other finance industry, there's quite a lot of jargon and trying to work out what you're actually paying is quite difficult. So with the bundled fee kind of like interest-free offering Select, it just allows the director or the person in the finance team to understand what that actual cost will be against their margin.
Yeah, it's easier to project then what the cost's going to be. Yeah.
And it's those products are like for more new start businesses that potentially don't have like an accounts or systems and procedures in place, and we can aid with the credit control, and the more the admin burden that it might put on the business. So
yeah, that's really interesting. So the other product, and this is one of my favourite products, is LedgerLite.
Yep.
So I want to spend a bit of time on that, if you don't mind, because I think our audience may not be aware of LedgerLite. We're always talking about it as an option. So would you mind just running through LedgerLite and why it's such a great product, and just tell us how it works? Because I love, I'm a big fan of LedgerLite.
Yeah.
So
well, it's like our invoice discounting. So it's for more established clients that have accounts, systems and procedures in place to be able to manage our facilities effectively. With the LedgerLite, we saw a gap in the market a few years ago that people. Banks are not offering overdrafts anymore, and typically when someone wants a cash flow product, probably the overdraft is probably the easiest product to get, or they want. But
it
was, but obviously people don't offer them anymore as much due to preferential creditors and all sorts of other issues. So we found a solution basically, which because some of the barriers to getting invoice finance. So it kind of like got an overdraft feel to it. So from our point of view, it's got minimum amount of admin for our clients. So all you have to do is send us a ledger every month. We effectively set a funding limit based on your average ledger for the last 12 months.
Right.
It's more.
What sort of percentage would you say that would be typically for? So they're sending you a ledger for the last 12 months. Let's say it's £100,000 a month. What sort of percentage is that? It's typically around 50%.
Yeah, it's about 50-60%, something like that. So if you've got £500,000 ledger, you're looking at about £250,000-300,000. So for most businesses, that's quite a chunk of cash, and I think a lot of people don't realise that they can access their aged receivables or aged debtors in this form to get cash out of it with such an easy, simple product as well, where you don't have to go through the full discounting route. I suppose from our point of view as well, it's more cost effective because typically invoice finance is the costing's based on the turnover that you put through the account. So if you've got a 20 mil turnover business, you're going to be paying your service fee on that whole 20 million, whereas most facilities we will ask the client, how much do you actually need? What is your cash need? And we will set our limit and the cost of the fixed fee against that funding limit. So typically when we say it's about 50% of what a discounting facility will cost you.
Yeah, I've seen it. I've seen it actually reduced about 50% on the service fee. If someone's paying a couple of £1,000s a month. Yeah, and we like to call it, you like to call it an in case of need product. Yeah. Because as you were saying, we were chatting earlier, you were saying sometimes it's seasonal, it might be for VAT. Yeah. What would you say about that? It's normally, some people might just have heavy, it might be seasonal. Yeah. It might be the VAT quarter, might always be a bit tricky.
It doesn't really typically work for seasonal businesses because obviously they peak and trough, and we want a steady ledger. But, as far as it's about smoothing the cash flow out, so, but a lot of people that we have it, they don't want to, or they don't need to use 80-90% against the invoice finance facility the full year. They may need to dip into it for a VAT quarter, or we see it quite a lot in recruitment where they will have to pay their commission, like large commission payments to their staff in January, so they might dip into it then.
Right, yeah.
But it's perfect for an just in case need, and they can just pay a monthly fee when they don't need to use it.
Yeah, and I think one of the things. You don't need to upload all your invoices, as you've said, it's just sending a ledger once a month. And you can imagine if someone's doing 10, 15, 20, 30 invoices a week, that's a lot of admin work for someone, isn't it?
Yeah.
So you're saving the money there as well. Yeah. And it's a little bit different with the guarantees. So would you want to just mention about the
Yeah, well, so I suppose from our point of view, we're funding businesses which are established, profitable, probably good tangible net worth. So it does reduce the need for personal security. And in most cases that we do it, we'll just do it on a warranty basis, so there's no need for a personal guarantee.
So someone could potentially have an invoice finance facility, they're finding it's a lot of admin, they're paying somebody to do that. potentially reduce the amount they spend on their service fee and take away the PG that they'll have with their invoice finance facility.
Yeah, potentially.
Yeah, that's brilliant. Yeah, fantastic. As you know, we're big fans of LedgerLite, so thanks for that.
So
I'd like to touch on this. I always find this interesting because when you're looking to approve deals, obviously you've got your team that come to you, but you're actually on the credit committee, and I thought that was quite interesting. So can you tell us about what some cases perhaps where something's come to you, there's been like an urgent need, someone needs money straight away, and it comes to you, and you don't have to go through levels and levels of upper management. You can actually influence it.
Yeah.
Could you tell us about?
Yeah. So I mean, for us, one of our key sell points and always has been is a flat management structure. So we want people to have access to key decision makers rather than having to go up the chain, like you say. Someone goes out and then they put through the processes, but then it slows that down a lot. Most of our guys on the ground as well. Simon Lockley, who's the regional director for the Southwest. He can come to me, and we very early in the process we'll talk about the credit. He has access to the key decision makers as well, and we will talk about deals very early on in the process, which then stops protracted issues further down the line. We work slightly differently as well, as that we will pretty much pre-approve anything before we go to survey, so the new business guys will pretty much get a nod on it before we waste any of the customer's time.
Oh, that's good. That's a great turnaround then, isn't it? Yeah, so that's great. That's fantastic. Thanks for that. So I want to there's one or two more things. So just want to find out, so what does a lender want to know when they're approached by the client? We talk about the three legs of the stool, which I always find an interesting analogy. So would you mind just telling us about that?
Yeah. So I mean, it's obviously like an industry thing, the three legs. So people have look at the legs in different ways, but the way we look at it is debt first, then the people, then the financials, and those are the three pillars of the credit decision, effectively. So if from our point of view, is the debt, and we're a debt funder, so that's pretty much our first focus. And it's if you've got £1 and we're going to lend 80 or 90p in that pound, we're going to get the 80 or 90p back, basically. And that's where you'll look at how simple the debt is. So when we talk to clients about what's your paper trails like, and you've got good proof of that debt, because that's what we need to prove when we go to credit committee, that you're going to be able to collect that in easily. The people, are they credible? Have you got good people that are going to stick around and help you if everything goes wrong, and they're going to help you collect the debt? So for us, it's the debt and the people, and the financials. On the bigger deals becomes a little bit more important, but on the smaller deals, a lot of small businesses at the moment are struggling. So you'll find a lot of businesses which are financially, making a loss. They might have arrears in some part of their business as well, which we will take a very pragmatic view of. But it's obviously for us, we will not. It doesn't affect our funding decision, but we'll need to make sure that there's a plan in place to make sure that business is viable moving forward.
Yeah. Why has it happened?
Exactly.
It's going to go moving forward. So Ian, the last thing then. So what would you advise someone who's potentially thinking about looking into invoice finance before they approach a lender?
So for me, it's get all your info up to date. So get your ledgers reconciled, get your accounts up to date, get your Xero or your Sage software, or whatever you input into. Because the amount of time that we sit into people and they don't have that information for us. Secondly, when you start engaging with a lender, make sure that information flow comes across quickly. Because this all forms part of the credit decision about how you'll be able to manage our facility moving forward. So it's very important that, and we see it numerous times where you're waiting weeks and weeks for information, and it starts to are they going to be able to run this facility for us?
If it's that difficult to get information out of you now, while you actually need money and you need to do something. How responsive are you going to be when if there is an issue once you have got facilities set up? So that's really important, isn't it?
And I think finally, it's like, make sure you get everything out on the table. Don't leave anything in the closet, because the worst thing is that a funder will find it out, and they find out the 11th hour, and if you
trust has gone and credit has gone, then,
exactly. But if you get it all on the table, there's always a way of structuring a facility. We just need to know all the facts at the start, good or bad. And I suppose for me, the one thing that probably our industry isn't great for, but it's, I think if you get a term sheet or an indication of terms from a lender and they've received no information, how credible do you think that offer is going to be? Because they've not assessed your debt, your financial viability or anything about that business. They've just, put a set of terms on the table. So for me, I think, when you, and the good brokers out there, like yourselves, you will gather the information and give the lender a pack to base the decision on. But, when you're getting a term sheet and you've not given any information across, you have to probably think how accurate or even deliverable that offer will be.
And that's the problem. If they say, well, we're going to go with them, look at this offer we've got, then a week or two down the line, by the time they've got all the information together, and they go, oh, actually, we've wasted 2 weeks now. They've seen, oh, well, actually, you've got some CCJs or even some time to pay arrangements you haven't told us about. And they go, well, actually, no, it's either going to be this rate or actually it's not one for us. Yep. So that client then who's in need of that money has wasted all that time. Yep. So that's why you may as well just be honest and say, this is the issue. And then especially as brokers, we'll know we don't want to waste your time either. We don't want to bring you deals that aren't going to be a good fit for you. So we try and get all that information off them up front. So that's brilliant. So that was really, really useful. Anything else you'd like to add to the...
Well, I think that's it. No, thanks very much for having me.
It's been a real pleasure. Thank you very much, Ian.
Cheers, Phil.
And thank you everyone for watching. Please like and subscribe, and we'll see you on the next one. Thank you for joining us. If you have any commercial finance requirements, please contact us at thebestgroup.co.uk.